Back in early April, the FHA introduced a proposed rule for a 40-year loan modification option. The FHA is currently accepting industry feedback on the proposed rule, but the concept got us thinking, should there be a 40-year mortgage option for all home buyers? I'm Diego Sanchez, COO of HW Media. I'll be joined today by Brendan Kelleher of the Mortgage Bankers Association and Angel Hernandez from Stavi. I've prepared a list of seed questions, but our distinguished panelists have agreed to answer as many audience questions as possible. If you'd like to ask a question, please use the Q&A button at the bottom of your Zoom screen. Today's Lunch and Learn is presented by Stavi. Gentlemen, let's get started. So Angel, what could you just take us to the basics and walk us through what is a 40-year loan modification and what is its current status at the GSEs, Ginnie Mae, and FHA?
Sure. So I think at a high level, when we speak of a 40-year mod, we're speaking about the ability to take a loan's existing outstanding principal balance, right? Perhaps including some arrears or any funds that may be owed due to delinquency, and reamortizing that amount over a new term, right? Up to 480 months, right? So that's where we get the 40-year from. In doing so, right, we were able to hopefully achieve a lower payment for that homeowner. In some cases, there can be additional relief provided by, let's say, taking a principal amount and just doing a principal forbearance that becomes payable at maturity or upon another loan payoff event. Or in the case of, the proposal you referenced with FHA, right, where that principal can be deferred as part of a partial claim. Again, same dynamic. That's an amount of principal that is also pushed out to the end of the life of the loan, to reduce the amount in principal that is being reamortized. Again, so typically when we see this option, the objective is the same, and that is to achieve a much lower monthly payment for the homeowner at the time of loan modification, right? Particularly if you're with someone that has faced a significant change to his or her financial situation. So again, generally speaking, that's what we're talking about, being able to reamortize an existing principal balance to an extended term with the hope that we can reduce again or achieve a lower payment reduction. The GSEs have had that option as part of the Flex Mod now for some time, right? That one again can be coupled with principal forbearance. Likewise in the Govy space, right? So I think not necessarily always 40 years, but definitely beyond 30 years is something that's been an option on the VA side. And now that we have FHA unveiling this, right, we're going to also bring some parity there. Now, the most recent development, perhaps in terms of availability, has really been where can those loans go into the secondary market if it's, again, a Govy loan. So last October, if I recall correctly, Ginnie Mae published APM 2105, where they did announce a new pool type, CET pool. This is a custom specified pool that will be able to house 40-year mods coming from any of the Govy programs that Ginnie Mae supports.
And Brendan, we FHA has been seeking feedback, and I know the MBA participated in that feedback. Can you give us a sense for the overall tone of that feedback? Like, how's the industry feeling about this, particularly the MBA where you work at?
Yeah, absolutely. So our tone of our feedback to FHA's regulatory proposal was very supportive. As Angel said, the 40-year modification is a loss mitigation option, right? Intended to help borrowers who are struggling to afford a payment achieve an affordable payment. And so that's the sentiment that we echoed in our letter that we sent out at the end of May. But the content specifically, right, really focused on a few issues, though, just to highlight. One, making sure that we express support for the 400 a term up to 480 months or 40 years for standard loss mitigation and natural disasters, right? So make it make it available. Consider the option to be available for standard loss mitigation for the future, right? And of course, we highlighted and echoed the concern for the secondary market liquidity that Angel knows really well. But we also made sure that we highlighted the importance of ensuring that the 30-year mod or 30-year is a core component of a modification structure, loss mitigation structure moving forward. So in essence, that it really became the 40 years really the last option, right, to help borrowers achieve an affordable payment. So overall, I would say, though, we highlighted some concerns and echoed some, highlighted some feedback, expressed a lot of support for FHA's proposal.
So tell me a little bit more about that, it being the last option. What do you want to see happen first in that mitigation waterfall that people go through?
Yeah, so that's a good question, right? And so the current waterfall, I guess the short answer is continue to evaluate consumers or borrowers for achieving an affordable payment at a 30-year term first, right? That's standard practice today, and we believe it should continue. There's a number of reasons for that, but primarily, one I would say is making sure that, well, sorry, I want to take a step back and echoing the reason why we're saying that is we still agree that, there are reasons for supporting a 40-year is still a balancing of interest, right? We are supporting a 40-year to keep a consumer in their home and prevent foreclosure, but recognize that there are some balancing of risks, right? It's highlighted here, though we don't talk too much about it, is slower accumulation of equity. And of course, the big one is, 30 years versus 40 years, you're talking about additional interest paid. And I've seen a few analysis, and it can be a lot of additional interest paid that a consumer would have to pay over the term of a loan for 40 years versus 30 years. And that's obvious. So there's consumer interests to making sure that clients can achieve a stable payment, an affordable payment at a 30-year term. And so that's what we mean by make it the last option, that because you're really essentially balancing interests, that you should use the 40-year as kind of a last option to get to affordable option. Yeah, that's really largely what I'd say. And then I'd also echo that there's and I know Angel and I are probably going to get into this a little bit, but you're talking about 30 years and making sure you have enough volume for the 40-year. And before you get into that, you want to make sure that you are securitizing those loans and offering them up to the secondary market that really need the payment reduction at the level that 40-year would get to or could get to.
Diego, what I would add, perhaps just a different way of looking at the same analysis that Brendan just shared is, it's about finding what is the right amount of flexibility that servicers ought to have within their toolkit to meet the needs of the homeowner they have on the other side, right? So certainly, in some cases, it is that 40-year mod option with the partial claim that is going to give them the deepest discount to their monthly payment that they need, right? But in some cases, a homeowner may not need that deep of a payment discount, right? So it's worth noting that for anyone that can perhaps achieve for any homeowner can achieve its, their objectives without having to extend up to 40 years, again, for the reasons that Brendan noted, it's probably better if we're able to still put them into the standard 30 years, right? Likewise, some of the concerns that were outlined in the letter really deal with, well, what do we do in scenarios where even that current combination, right, is not enough? Right? Is there anything else that could be done to achieve an even, further payment reduction, even if it means having to do some additional verification, from the servicer, or, if it deals having to document additional things? How do we then address the other population, right? And the last thing I would say is, again, it's all in the same of having ensuring that servicers have the right flexibility and toolkits at their disposal. It's also not maxing out relief. I know that sounds a little odd because we all think in terms of, well, we want to be able to give the homeowner, what's best for them. And I agree with that, right? Except that, for maximizing the relief, we also have to consider what could happen, in subsequent events, right? So if, so to Brandon's point, if the first step right out of the gate, when someone needs to reduce their monthly payment is to obtain a 40-year mod, perhaps with a partial claim or some other form of principal forbearance, then it may severely limit our options if there's, let's say, a natural disaster, right, that necessitates the need for further relief a year, 2 years from now, right? By the same token, right, there may be some homeowners, and likelihood anyone that stayed in forbearance for extended periods, is going to fall into this category where it kind of doesn't matter, right, if you can't save anything else as a last option because they need an option today, otherwise they lose their home, right? So again, those are two different scenarios, and the 40-year mod and whether it makes sense or it doesn't is going to play very differently depending on where that homeowner is. So again, it's about really ensuring that servicers have the right right flexible tools in their arsenal to address whatever need that homeowner might be facing.
No, that's spot on. I think maybe it's worth maybe a point of clarification on how just to say to folks, we have the regulatory proposal, which is just simply that, changing the regulation from to allow the max term from 30 years to 40 years. But then, FHA had their mortgagee letter that came out earlier this year for the 40-year for COVID specifically. And,
sure.
and that is the current structure that is, well, in addition to USDA and VA, that's driving volume that consumers are being evaluated under. And anyway, just to your point about, leaving that flexibility for consumers in future default cycles, that's the flexibility that we were thinking about in terms of our response.
Angel, from your perspective, are there additional pros and cons that are worth discussing, in terms of the 40-year loan modification?
Yeah, earlier you mentioned that we agreed to answer your questions. I don't think that we agreed to answer all of your questions differently. So this answer might sound a lot like the answer I just gave. So I apologize to the audience for that ahead of time. But certainly I think, Brendan, touched on some of those, right? And that is as we shift into, again, 40-year terms, we do have to ask, well, what is this going to mean, right, for the rate at which equity is accrued on those properties? And again, if this is the one option that you have that lets a family stay in their home, then that's probably well worth giving up on some of the added equity that you could be building on a 30-year. We also have to start thinking a lot about, again, the secondary market, and I think we both touched on that, right? And that's at what point are we going to have enough volume of those mods such that there can be, accurate pricing discovery, right? I think even to date, given that most of the 40-year mods are really coming from kind of VA or RD on the government side, there's not. And those are custom pools, right? Those are custom specified pools that Jeannie put out. So it's going to take a little bit of time to understand what that pricing mechanism is, and also to understand what this means for servicers. And I think, look, I'll be the first to say, I think our mortgage servicing community has done a phenomenal job over the last 2.5 years, just really implementing a wave of regulatory and government agency changes that have come out, again, all trying to achieve the best outcome for those impacted financially by the COVID pandemic. So they've done a phenomenal job, but that all those changes, right, do come with cost, both operational cost, burdens on the people, right, having to learn and train staff, and as the servicers, we all know, right? It is that servicing income, and on the Govy side, perhaps what you can earn from any redeliveries that is going to matter. So we do have to pay attention to the secondary market for those mods, because it's going to impact, right, how much revenue the servicers have available to continue doing what they do. And which they've done a phenomenal job at. So again, that's a second bucket that I would say. So first, again, the homeowner perspective, what does it mean for homeowners? Second, what does it mean for our market and our ability and the ability of our servicers to deploy as needed? And the third thing I would put up there again is, and this is not an opinion in a way, just something that we do have to think about, and that is how do we create that balance, right? And this is why I said I was going to go back to my previous answer, and how do we create that balance that that we are delivering the right tool to the right or the right option to the right homeowner. Right, because we certainly don't want to be in a position where we've exhausted our options for subsequent cycles. So this is all calibration. I don't think any of us can get this down to an exact science, but it's all considerations worth continuing to think about and continue to discuss, because the likelihood is the same thing would apply to similar moves in the primary market.
Yeah, let's quickly dig a little deeper on the equity considerations, because that was something that you and I discussed in our prep session, and I hadn't really thought about fully. What are those homeowner equity considerations, Angel? Like what do we need to be thinking about when we talk about 40-year loan modifications in terms of the impact on a homeowner's equity?
Yeah, sure. Well, I mean, I think maybe let's take a step back for a second. And I think there's been robust discussion from all of us in industry about what is that we can do to advance both access and wealth building, right? I think those are, dual objectives that we all sort of agree we should pursue, right? How do we create a more equitable housing system? So when I look at the impact of an extended term, I mean, it does mean that, again, whatever equity that homeowner would get is going to be earned slower over time. There's obviously a lot of other factors that are going to come into play here, right? So we've just experienced tremendous growth or increases, I should say, in home prices, right? So that's, that immediately perhaps could offset some of those concerns. But we are now entering perhaps a different dynamic, right? As interest rates rise, likelihood is home price appreciation or home appreciation growth is going to be declining. So again, we simply have to just ask the question of, are we in fact putting that homeowner in a better position than they would be if say they're able to perhaps sell the home, right, and maybe going to a different home with the better payment, better terms. Again, I don't think there's one answer that's going to fit all or is going to fit every scenario. All I'm trying to highlight is that there are factors that we need to consider to ensure that we are doing the best that we can by the homeowner, both to ensure that we retain as much access to homes and home purchasing as possible, while also ensuring that there's some value, right, that transfers to that homeowner for all of the hard work that goes into being able to purchase and maintain a home.
Yeah, that's really helpful. I think we should dive into the secondary issues. And Brendan, I'd love to get your perspective on this. It seems like it's the it's the main obstacle for us to be able to scale up 40-year low modifications, and certainly if we ever want to consider originating 40-year mortgages, the secondary market is a key consideration. Where do you think we're at? What are the secondary market considerations of a 40-year loan modification? Oh, you're on mute.
My mistake. Apologies. Where are we at? We are at the beginning, right? Like we talked about, the Ginnie Mae securitization structure for extended terms is new, and as of October, as Angel highlighted, and so we're just beginning to see volume. And personally, I'm not yet sure how they're being priced. I think what I'm hearing is the pricing for extended terms. That is beyond 360 months or 30 years to 40 years is variable. And so there's not necessarily a lot of certainty, meaning that these are going to sell at the secondary market for a return, a good stable price. So, but what do we need though? I think there's a few things. The short answer is, of course, volume. But we're not there yet. Of course, we got the COVID, and I believe that's small volume right now. We have the FHA that may add more volume, especially with that partial claim variable that Angel highlighted as well, may drive some more volume in the current rate environment. But we certainly need a little bit more study and analysis of what needs to be done to increase liquidity and ensure certainty. And so one of the things that we highlight in our letter, and we talked about this briefly, is that the extended terms are custom single issuer, unlike standard Ginnie 2 pools, which are multi-issuer, where you can securitize from obviously multi-issuers and increase volume per pool. And we believe that that Ginnie Mae should consider reevaluating their pooling structure to increase liquidity. But of course, before they do that, study the results of COVID. But the short answer, I think, in all of that is, evaluate, I guess, drive volume, but more to it, ensure that, consumers and borrowers have the right option that works for them. But I'm certainly, I know this is much more your wheelhouse. I'm curious what you think in that regard as well.
Sure. So as right, I've spoken to folks about this. It's a couple of things I think I'd like to note right up front. So first, there is some appetite for 40-year paper, right? There's definitely some appetite that does fit, with the outlook of some in the capital markets. So I think that's one. Number two is, when it comes to pricing, right? This 40-year pools are going to be subject to a lot of the same dynamics that every other, pool is. And that is, for example, concerns around prepayment. And it is here where I think having additional volume, is going to matter, because it's going to enable the capital markets to better delineate, right, what are the factors that are going to impact the prepay rate on those extended term pools, right? So on the positive side of the equation, one could say, well, these are going to be, again, if we're dealing with the COVID, an influx from COVID, right? To the extent that those are months that were already executed, they're probably going to have a lower interest rate than perhaps what the market rate would be today. So there's a natural difference against prepayment rates in that these are not subject to refinance risk as much. Look, even if that wasn't the case, right? Even if we're dealing with similar rates, the fact is, refinancing into a 30-year loan, in most scenarios, it's not going to yield a better payment or, a more favorable payment to the consumer than the 40-year term, just again, because of the amortization periods. So, so one side of the equation, there is perhaps some built-in protections against prepay risk that the standard 30-year TBAs are typically subject to. On the other hand, because these are all modifications, right? I think we still have to see how well those loans are going to perform, which that could be another source, of early exit for those loans from the pool. And even there, right, we have good things going in and perhaps not so good things going in, right? So on the positive side, we know that, there's been a deep payment, reduction that would accompany those. If we look back at sort of the reperformance rates of mods, at the end of the financial crisis, we could see there's a significant performance differential, right? In scenarios where we had payment reductions in excess of 20%, for example, right? So that's certainly a box we're able to check with a lot of these 40-year mods. But again, I think the premise is that so many of the homeowners that need this option just experienced a substantial, financial event. So when we look at everything else that is now occurring in the economy, right, they are susceptible to it's likely they're susceptible to those economic shocks, right, which again, could point to perhaps, an added risk of redefault and redelinquency that, would signify by extension a risk to the MBS investor that they're going to exit earlier than anticipated. But look, the easiest way to resolve where all of these considerations and factors would fall really is by looking at how those extended term pools behave. And we can only do that with volume, right? And that's also how we're going to be able to get a mix of different entities and different product mixes in those pools so that we can all get a better idea.
And do both of you see that volume starting to ramp up a bit, over this past year, or are we still kind of in the very early stages? Maybe we'll start with you, Brendan.
I think it will. So I guess too early to tell still. We're seeing, you're going to see more of the MBA data come out later today. So little plug there, but you're going to see, forbearances clients continue to exit their COVID forbearance with the ML 2207. What was valuable about that is that highlighted the partial claim as a deferment option to achieve affordable payment after a 30-year and also after the 40-year. And now that you have the modification coupled with the partial claim for FHA, could drive more volume as a result of that for COVID specifically. I don't know yet if that will be enough volume to make an informed decision, though, at this time. That's why I think the reg proposal is valuable, because over time you do build volume and you gather more information to make an informed analysis. But I think to your question, short answer is yeah, still a little too early, but I believe that the FHA COVID rule will help drive volume more than if we didn't have it.
And I think you bring into the table the point about the regulatory change, and I do want to emphasize that again, because it does then point to continuity, right, of 40-year mod production, which is definitely also going to weigh for the liquidity of those extended term pools, right? I mean, this is not the first time that there's like a 40-year pool in the Genie program. There was the Hope for Homeowners program, again, associated with the financial crisis. But the issue becomes that once, whenever the loans that make up those pools are limited or tied to a specific program that has an end date, right, or the end of duration in sight, the pools that are housing those loans can themselves begin running into liquidity issues as the balance on those MBSs begins to pay down, right? So there needs to be, ongoing production, for lack of a better term, right, to create new pools to enable, something even as, additional modifications, right? So what happens if you have a homeowner with an existing 40-year mod term that then needs to go into, in 5-10 years, needs to do another mod, right? If they need to have an option similar to what they had, otherwise, your in essence going to now be shortening, right, the amortization period to a much shorter time frame that is in all likelihood going to increase the payment, right? So it doesn't, both from a public policy perspective, right, and as well as a secondary market capitalist perspective, that there needs to be again a vehicle available in perpetuity for the loans to be redelivered, and for that to be liquid and robust in the market. There needs to be programs that are not tied specifically to COVID that create the 40-year products in the first place.
So I'm gonna jump in with an audience question here, and we talked a little bit about this in the beginning, but there are some folks who weren't able to join until more recently. So the question is, do you think that the 40-year loan modification should completely replace the 30-year loan modification? And this person further said, they asked because comments submitted, during the industry feedback period have suggested that might be a good option. I think I know what your answers are going to be, but maybe we should just, walk through that. Should 40-year loan modification replace 30-year? Angel, why don't we start with you?
Diego, again, I promised I would answer every question. Now that I will give you a different answer each time. So look, and this is just from a very personal perspective, right? So, speaking on a personal level here, look, I think it's about having a robust set of tools made available to servicers, so they can meet the homeowner in the time of need where they need to be met. And again, I think for that purpose, the 40-year modification is a great option. And I'm glad that at least for the COVID impacted homeowners that we've made that available. But I think that if we made that the standard each and every time, I think we would both, be harming consumers in some scenarios, right? Actually, in multiple scenarios, right? I can see where that's the case. Again, where they don't need that type of payment reduction, we're simply slowing down how quickly they can own that home free and clear. And then on the other side, right, in cases where they could have needed relief in multiple instances, if we max everything out on this go around, we may be facing more limited options down the line when we need them.
So I don't have much more to add. I think that's spot on.
Yeah. I mean, basically the answer is it should be one of the tools in the toolbox, not the only tool in the toolbox. Exactly. And I think that makes a ton of sense. Appreciate you hopping in there again, Angel. Just so everybody knows, if you would like to ask a question of our distinguished panelists, you can click the Q&A button at the bottom of your Zoom screen. And we will see those questions. So guys, rising rates, they have risen at an incredible pace over the past couple of months. And we're around 6. Speculation is we could be at 7 at some point. What do those rising rates mean for this concept of the 40-year loan modification? Angel, why don't we start with you?
So I'll say 2 things in response to that. So I think it highlights the need for servicers to have the processes in place to ensure execution and redelivery of those mods in, as timely fashion as possible to minimize any exposure risk that they may have to fluctuating rates. And B, or I said, I didn't say A and B, I said 1 and 2, right? So that's the second point there. So I don't want to confuse anyone with it. Is this 1A or is this, we're moving on to the second point? And the second point is that, unfortunately, because of the rapid, the rapid rate of increase, it is probably going to undermine, our ability to deliver as deep of a payment reduction as we would have liked, right? So again, I'm going to speak particularly on the Govy segment of the market, right, where where those mods do get redelivered into a Ginnie Mae pool. Again, that's going to have to be at market rate, right? And I think even the FHA proposal provides for PMMS, plus I think ends up being 50 basis points and 125 basis points altogether when you add it up. But that is to say that the market rate is going to influence, right, or provide a floor for what rate can be extended as part of those mods. And again, the higher that rate goes, notwithstanding the extended amortization period, it is going to impact, again, how deep of a payment we're able to achieve. But for both instances, I think, I would say that it really is that first point that I want to emphasize, that, there's a need to be able to reach the homeowner, identify the loss mitigation option that fits them, execute that, and redeliver in as timely fashion as possible. And look, from a Stabby perspective, that really is where I think technology can help, right? So we've developed recordable digital mod solutions such that you're able, if a servicer wants, they're able to reach the consumer and execute a loan modification via an audiovisual session, just like we are today, when they reach them, if they wanted to, right? Again, and be present for the execution of that mod, notarize that modification as needed, again, to try to shrink that timeline that exists between when an option is identified and when the servicer gets a hold of a completed package that is completed both fully and accurately. So again, I think technology has a big role to play in that.
Absolutely. I agree. I mean, you said it really well, scale up, because it will make, to your point, it will certainly make achieving an affordable payment more challenging with the rising rates. So no, I completely agree with what Angel said. Scaling up, reaching borrowers, and engaging with them to check in and make sure that they have the help that they need and the solutions that can be available. But it's certainly for the purposes of the 40-year, it reinforces it as an additional option. So that makes it a good idea, but recognizing that it certainly makes it more challenging, a rising interest rate environment.
Again, Diego, and I really do think about what timely execution is going to mean here, right? So if we go back to kind of like traditionally what we've done in paper, right? Is a servicer is able to reach a homeowner, identify the loss mitigation option or the loan modification terms that fit that consumer, and there's like a shipping of documents that has to take place, right? And that homeowner has to wait for those documents, read through it, execute, perhaps go find the notary, send it back, and if everything goes well, the servicer gets that back timely and the package is completed, accurately. Again, at Stabby, one of the things we're saying is, hey, we can modernize that process, right? We can make this be, real time, where you're present when that execution is happening, where you can ensure that loan mod package is completed per your requirements, so that any counterparty that you have downstream, whether that's another aggregator or again, if you're delivering that into the secondary market, that you're going to have again a good mod that you can do, again, shrink that timeline so that you don't have to wait a month, because as we know, if you waited a month, right, the rate that you offered a month ago, right, might be 75 basis points under the market rate by the time you get that package back. So I think it does highlight the need to have, again, the necessary tools at your disposal to execute in as timely fashion as possible. Sorry.
Anna, let's stay with you for a moment and talk more about technology considerations. You talked a little bit about what those are and where Stabby can help. Let's dig a little deeper. What do you think the major technology considerations are of a 40-year loan modification, as we stand now?
Yes, I mean, this might be the fifth time I say that in this session. So I'll answer every question, maybe not with a very different answer. So I think two things we have to consider, right? Data and information. And then doc execution, right? So those are, again, two factors that we have to think about when it comes to identifying and getting to the right loan or loss mitigation option for any consumer, right? It's either going to be able to get information quickly, get information that is accurate, and being able to then act on that information, right, from a servicer perspective. And then again, once you have that loan modification, that document package, then I think it becomes the same two factors going the other way. Right now, it's the servicer that has to be able to transmit the associated data and transmit the associated documents, again, whether it is to another entity or into the secondary market. So at a very high level, right, I think technology platforms are able to eliminate all of the fragmentation that exists today with manual processes to create a lights out process for the transmission of both the necessary, data and information that you need, both from your own servicing systems as well as from the homeowner, right? And really bring them together into a platform that lets you generate the docs in the manner that is required to meet all necessary, state, federal government agency requirements, as well as secondary market requirements, to then transmit that back out into the market. So at a high level, I think it's technology lets us eliminate all of the fragmentation that comes from manual processes, whether it's for, again, originations, or even in this scenario, right, loan modification and loss mitigation scenarios. So this is something that at Stavi we've spent quite a bit of time thinking about, and that is how do we deploy, again, all of the tools that we have focused on for the origination section, right? Whether that's electronic signatures, remote notarization, doc collaboration and review, data exchanges. How do we now then bring all of that into the servicing space and partner, right, with servicing systems and with servicers to create a full ecosystem, right? So again, something that we're obviously very excited about at Stavi. But again, if we think about just those two sort of channels, right, of information and documents, and the fact that today they have to go largely through manual paper-based processes, when we think about what we could enable if we eliminate the paper and go to a technology solution, I think it's pretty incredible what we could achieve.
Brendan, I'd love for you to weigh in here. You come from Rocket, recently joined the MBA as a servicing expert. With servicing being the main part of your portfolio there. What are any additional technology considerations? What role can technology play as we figure out the 40-year loan modification?
There it is. To be honest, I think Angel hit it well, right? Yes. He talked about the digital platform, the doc execution. I think it is one. So when it comes to the 40-year, just being able to use your internal decision engines to evaluate quickly and to communicate quickly to borrowers. So creating that experience for them that is how you interact, how you communicate online more digitally, to give them the opportunity to raise their hand to get help and go through the loss mitigation waterfalls or process on their own, and building in those rules clearly that they can understand that it arrives to the right decision.
Yeah.
So technology to get to quick and clear outcomes to help borrowers into solutions is the importance. And especially if you're qualifying, or you may be a consumer, you may end up qualifying for 40-year, that only reinforces the need to get to an outcome, a favorable outcome, a home retention outcome as quickly as possible. If you need a reduction, you need it fast.
Yeah, imagine, for the borrower, whether they're online or on the phone, the decision tree needs to be really good and effective and smooth, because you've got 10 minutes with them on the phone or whatever, or it needs to be a clear and effective process online. On how I imagine you're building that decision tree into your software at Stavi.
One of the things that we equip our servicing clients with is one of the first things we expose is our eligibility engine, which lets them identify right off the back if this homeowner is eligible for a loan modification. Can that be a digital modification, right? And if so, can I electronically record that once it's executed, right? Again, in the case of a Govy loan. But I think what you're highlighting here, Diego, it's probably even a discussion point at a higher level, and that is that for every change, right, that is implemented, as we both noted earlier, there's going to be a massive amount of work that servicers have to undertake. So, figuring out what is that right mix of the tasks and functions that you're able to do in-house versus how many of those you can partner with an external party that perhaps is a little bit more nimble for things, right? I think that's something that I would really encourage everyone in the audience to perhaps go back and evaluate, right? Because it is the rate of changes that often can be crippling, and having, again, the right partnerships and collaboration in place, such that any core functions, like, again, the decisioning of what a homeowner is eligible for, can be partnered with the right execution method of each of those, right, in a way that, again, is going to let you implement whenever changes are allowed. I think it's a crucial thing. So that's probably what I would emphasize on, right? Just figuring out what is the right mix of in-house versus a third party, and how how we can all support each other, and again, rolling out those benefits to the homeowner as quickly as we can and in the most accurately way possible.
Well, and it has to be super flexible because, just looking back on the first couple months of the pandemic, as the government thought through the forbearance option, and there was legislation, and that legislation had to be put into effect, and a lot of rules around it, and those rules kept changing, right, as we got deeper and deeper into the pandemic. So flexible technology is probably pretty important. Awesome. So would love to maybe have a little bit of a bonus session here, where we speculate a little bit. So we've been talking about the 40-year loan modification, and it does seem like it's an interesting tool in the toolbox for servicers. What about originating 40-year mortgages? I bring this up because we frequently from our audience, have bin hearing about affordability concerns, particularly with increasing home prices over the past year or so. There's not a lot of houses out there that are affordable for most folks. And so, why not have a 40-year mortgage, which, can extend out those payments, make those payments lower, make homes more affordable for folks. Would just love to get your high level thoughts on the 40-year mortgage, and maybe we can do a little speculating here. Angel, why don't we start with you?
Well, if earlier I said that it's important to have all the tools available for loan mod, I can probably bank on that answer yet again. Look, I think it's worth discussing, right? There may be scenarios, and quite a bit of scenarios where a mortgage with an initial 40-year term might make sense, particularly, again, across a spectrum of macro circumstances. I do think if we just sort of like peel that back from the theoretical to the practical today, I would say that there would be some concerns that I would have, right? And that is, to what extent today would that simply lead to, again, reinserting a lot more demand that we're just shedding, given the limited, supply that we have in housing, and what will that do to home prices, and would that just erode away any affordability? So I think, not that it's not something we should consider, but perhaps in my list, it doesn't rise to the top as much as, let's say, ensuring robust supply and seeing what we can do about supply and bringing down the cost in the supply chain could do for affordability. I could probably say the same thing about rates, right? In that, the only point of the 40-year term in creating additional access is that, as you noted, that we're able to then perhaps achieve a monthly payment. But so long as we continue to have rates on a skyrocketing trajectory, it won't be long before, those additional 10 years or whatever payment reduction could be associated with those additional 10 years is just eroded away by increasing rates. So I do think there's other probably like more fundamental issues that we're facing today that we should tackle to really be able to tackle affordability. And I think, supply is up there. The right allocation of product and product mixes even from what we have today. I think it's something else that we should look at. Alternative financing for other for other types of homes, right? I think there's like a lot of discussion that I've seen over the last 2 years under like shared equity arrangements, for example. Lots of lenders in that space. Again, they can achieve the same objective of getting someone into a home, letting them catch the upside, right, of any equity appreciations without necessarily slowing down or fundamentally changing the way the 30-year mortgages that we have today operate. There's also going to be all the same secondary market concerns that we talked about for the 40-year mods. I think those will be equally applicable here. In that, the premise here would be that we're able to provide a rate that is just as good on a 40-year term as we would on a 30-year term. And again, that's going to depend a whole lot on how the capital markets see, 40-year originations and what that tells them about, prepay risk, the likelihood of delinquency of those loans, right? So I don't think it's certainty that having that as an option would directly lead to additional access, absent other factors changing. So again, maybe not an answer, but just again, probably a series of points for us to consider.
No, I'll just chime in really quick, and I completely agree. I don't think, to my knowledge, that MBA has taken a position on a 40-year mortgage. But Angel's point that there may be more higher priorities to address affordability and in terms of access to credit and housing supply, especially in the market that we're in now. And I believe he said this, but I would just reemphasize that, we talk about or think about the concept of a 40-year. We've been talking about it as a modification, which is, a loss mitigation solution, a potential issue. And I think Angel said this, which is if you were get a 40-year mortgage, it would be tough if you struggle to meet your payment on a 40-year mortgage to get a loss mitigation home retention option if in servicing if you needed it. So that's just one additional consideration to think through. But anyway, I think, Diego, to your question, it's more of a thought exercise, certainly one that's interesting. But all the issues that we talked about today through the modification certainly apply in the front end, and maybe even more so. That certainly just need to be studied. But primarily, I think from the MBA perspective, there are tons of policy considerations that I know we're all fighting for to address affordability challenges that my colleagues at MBA could talk about as well.
Yeah, so maybe doesn't help the supply-demand imbalance. In fact, to your point, Angel, probably doesn't. And there are the same secondary market concerns, if not more so, right? Like we're in the very early stages of figuring out whether we can, sell 40-year loan modifications in the secondary market. It would be a while longer to figure out originating 40-year mortgages. And I think that last point is really interesting. Like, and we've talked about it a couple of times. What do you do in terms of loss mitigation if you're already going with the 40-year mortgage? I mean, is it a 50-year mortgage then, right? Like it's a slippery slope to at that point. So all really interesting things to think about. So our lead analyst, Logan Modishami, has a recession model where he looks at recession red flags. And he's got 6 recession red flags. 5 of them are now up. The last one is, when the leading economic indicators start to head south. And then he's on recession watch. If we go into a recession, what are the considerations and what's the potential impact on this 40-year loan modification that we've been discussing? Does that make it more important, less important? What are your thoughts? And I guess this will be the last question since we're about 5-0. Brendan, maybe we'll start with you.
Yeah, I'd say it. seems to be all the economic data, right, suggests we're headed into a recession. That would make the 40-year certainly as an option more valuable, but it depends. Again, a lot is very dependent upon that, right? What is the servicer's portfolio, their current note rate versus the market rate? But I guess in general, it provides an additional opportunity, right, for consumers who may struggle in the future to afford their payment to get there. But keep in mind, right now it's a 40-year, or it could, I should say, right, it could provide an opportunity. Keep in mind, right now the COVID is the 40-year for FHA and for in the Govy space is specific to COVID, and the proposal that we started talking about was a regulation that has not yet been implemented, but it certainly may give maybe more of a push from FHA to move forward with implementing an actual policy, or the Govys, for future standard defaults. And I know we're also keeping a lookout for the new regulatory agenda, which is supposed to come out, I believe, this month. But anyway, it increases the value and the seriousness of it, but for future defaults, certainly due to a recession, arguably which is due to COVID, but you need that policy to be implemented. Angel, what do you think?
Yeah, not much to add. I think you hit it right on target. Whether it's a recession or any other, macro event or even natural disaster that leads to financial disruption, I think anytime we see, again, that dynamic at play, right, financial disruption to a substantial segment of homeowners, the more tools we have, the better. So again, it would point to greater utility of a 40-year mod across the board. Again, not just tied to COVID. So long as we keep in mind, again, that it has to be one of several options, and perhaps not the only.
So quick audience question before we break. I think we can answer this one pretty quickly. When will the 40-year loan modification be effective? So I think it already is, but Angel, you wanna just give the final answer here?
Yes, I mean, I think for COVID, the announcement has been made for COVID impacted homeowners. For other non-COVID related delinquencies, I think that's going to rest quite a bit on the regulatory work that's underway. And Brendan, I leave to you to predict when that could come out.
I have no opinion on that, but yeah, you're right. We will see.
Gentlemen, I really appreciate you taking the time to join this panel today. I think it's been really informative. Appreciate you taking the time, and have a good rest of your day. Take care, everybody.